Take us through your latest report here. What's your latest takeaway?
Yeah, I mean, in terms of the number of or size of mortgages that are involved in the boycott, that's still relatively small. For most of the banks, they've publicly made announcements. In most cases, we're talking kind of 0.01% of their overall mortgage portfolio. So surely on the surface, it looks like it's a small thing. But the bigger issue here is whether things will spiral. There are also news suggesting that even some of the suppliers for property developers are now sort of joining the movement and suggesting that they will also delay repayment. So the major concern for us is whether, if the property market, if sales volumes don't recover as we expect in the second half of the year, what that ultimately means to the property market in the longer run and what that means in terms of banking sector resilience, because mortgage lending, by and large, is a very big segment for banks. On average, it's about 20% of a bank's loan book, and for some banks, that ratio can be even as high as 30%. So it is a major issue that we're watching very closely at Fitch.
So short term, is it still just a profit impact for most banks? It's not a solvency crisis. We're not even at that
point.
Okay.
Yes, that's right. But the concern is, with also broader economic challenges, some that's been brought by because of COVID restrictions, and also just tighter economic situations. What that means to home buyer confidence in second half, I think that's also something we're watching very closely, because ultimately, things are fine for a few months.
Until they're not sometimes, right?
Exactly. And if the housing transactions numbers don't come back, they don't recover, then that's when we're in a much bigger trouble in that sense.
And a lot of this is contingent, to your point, on what happens in the housing market, really like what happens in many places in the world, right? When housing prices are going up, most of the other sort of smaller problems go away. This report also bakes in the views of your colleagues that cover property, and what assumptions are you making as Fitch Rating as far as that's concerned? What's going to happen to the housing market? Yeah,
in general, we do expect some recovery, although we were looking at still just like single-digit growth into 2023.
Okay.
So there's we're still maintaining a very cautious stance on the property sector.
Worst case scenario, as far as non-bank NPLs, for example, are concerned, and do we get to a point where some of these banks need to raise some money?
Yeah, I think capital raising is on the cards, whether there's a crisis or not. For the larger banks, it's for regulatory requirements. For some of the smaller banks, it's basically the capital raising is just a way for them to keep pace with their expansion. So I think capital raising is going to be on the agenda. In terms of worst case scenarios, we've run various tests. We've run series of stress tests on the sector. Generally speaking, if we do see mortgage NPL rising over 2% from about 0.3% currently, then at that level, that's where we start to see more systematic stress for the system. That would be consistent with experience in, for example, Hong Kong and Taiwan.
Which seems a bit far away, given where things are, right? That's the extreme parameter of that stress test that you're doing.
Yes, that would be the kind of scenario where we would start to see the rating headroom start to deteriorate on a standalone basis for some banks.
Okay, so I'm guessing that's an indirect way of saying you're not even close to looking at changing some of your ratings here, or are you getting to a point for some of these banks?
Yeah, well, first of all, I would stress that for Fitch, our ratings on the Chinese banks are government support.
That's right.
Driven. So in that sense, that while there might be some deterioration in the intrinsic standard loan profile, at the moment there's no reason to suggest that these incidents will reduce government support propensity. So at the moment we've got a stable outlook on all of our bank ratings.
Yeah, the put, as they say. All right, some of our analysts here have also crunched their own numbers as far as the banking sector is concerned, and they basically said the big banks are going to be fine. It's the smaller, rural, local ones that you need to be worried about. Are you making that distinction too?
We don't we don't rate the small rural banks in China, but we have said in previous publications that yes, that's the weakest link in the system, whether it's exposure to property or exposure to weaker customers in general. they've always been the weakest link.
Right. Earnings season's coming up. Apart from this, what other themes are you tracking as far as the next reporting season?
Yeah, we're also looking at margin developments quite closely because ultimately, China's banking system is very reliant on net interest income. And unlike the rest of the world where rates are rising, in China where we're actually looking at a reduction in rate scenario, so that ought to have some pressure on margins as well, especially at a time when government is again still urging banks to lower borrowing costs as to reduce the interest burden for the average borrower.